This is a new episode of Global Ag Trade Brick by Brick on Connected Farmer with Mike Zuzolo. He is now ready to assess the cattle prices impacting the agricultural chain and yet the tariffs that will impact all the agricultural sector right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. So, directly from Kansas, Mike is ready to assess the cattle markets that got beat up last week. Before we talk about the tariffs issue, people are very interested about the tariffs, and we also got a question about from a viewer last time we spoke. But the I want to start by the cattle prices. How are they impacting the markets right now, and what are you recommending your customers?
Well, if you didn't get hedges on a couple weeks ago for downward price exposure and putting a floor in place, Luis, I would say hold on. Don't move yet. I wouldn't recommend putting hedges on yet because we have, or getting catch up hedges on yet, because we have winter weather coming back into the plain states. I think between that and the sharp discount in the futures market against the both cash cattle and cash feeder cattle market, we have an opportunity for a retracement and to try and test the strength of the short of the seller. But it's very clear right now, in my opinion, two things. One, the funds have started to let go of their long positions. And in the case of feeder cattle, their record net long positions. We've seen this now in the Commitment of Traders report where their numbers are coming down in terms of their net long position in both feeders and fats. Number two, I think at the start with the start of 2025 calendar year, the clock is now ticking on the demand side. In other words, I think we're in a serious situation of demand rationing now in the meats and the proteins. The best thing going for the cattle right now is the HPAI because it's causing a skyrocketing prices of eggs, another protein, and it's keeping the consumption and the demand intact for the red meats, for the beef and for the pork. But I think that only gets you so far. And as the high prices continue, and even if they go higher, which I think they could on the retail level in the next 30 to 45 days, I think we're going to have to be ready for a pretty significant amount of demand contraction and demand rationing. And so we absolutely, in my mind, need a weak dollar, and we absolutely, in my mind, need a strong stock market in order to keep the funds in this market at this stage. So it's showing weakness. It's showing the potential for a topping price action because we're rationing demand now, I think. So in the short term, you maybe can hold off on getting hedges, but catch up hedges over the medium term, I would strongly recommend.
And how are you seeing the recovery of the cattle herd in the US?
This is a really tough situation, Luis, and this is why I'm doing known cost hedges right now in the form of bought puts and covering just the second quarter of 2025. You have, on one hand, a recent cattle inventory report that shows that we're only down about 1% on feed. That matches with the recent cattle on feed reports that come out each month. And yet, our total slaughter year to date for 2025 versus the same time period a year ago is down 9%. I noticed on Tuesday's slaughter, cattle was only going to be at 100,000 head, preliminary numbers right before we jumped on the air together. And so we've got this huge disconnect about what is the supply of cattle out there. Do we really have 12 million head on feed? And if we do, are we backing them up that aggressively that we're going to have a huge amount of unexpected supply come in the second quarter and maybe the third quarter? So that's what I'm most nervous about. That's what I want to protect prices for.
Yes, and we had a viewer last time that asked a question about how tariffs would impact Brazil But first, let's touch on the things that we were discussing last time, and then we jump into the Brazil question because uh, we have had a pause for of a month on the tariffs that would be impacting both Mexico and Canada. And what I'm hearing about the Canadians, and I guess the Mexicans are the same way, is they are really scared about what can happen to their economies. Uh, but how do you think that that's going to play out? Because it seems there was a partial victory for Trump, but we don't know what's happening next because we he got something that he wanted, but we don't know what else he wants. So how do you?
Yeah, I think I can help there a little bit. I think when we last spoke, we talked about Panama and we talked about the President Trump's tariff policy and his economic policy and his trade policy were essentially one and the same. Since we've spoken, we see that linkage without a doubt now, in my mind anyway. Those three things are one and the same at this point. And so we have to take him seriously when he puts tariff initiatives out. The second point I would say about Panama is you notice what happened when the new Secretary of State went to Panama. All of a sudden, Panama, being the first Latin American country of the Belt and Road Initiative by China, doing that back in 2017, I believe it was, said they were no longer going to be part of the Belt and Road Initiative. That is a huge piece of the puzzle for me because number one, it is directly um, antagonizing and putting into China's corner the fact that we are looking at them directly. And I think this is important for the commodities in that President Trump's administration, I think, is developing a trade and foreign policy to contain China, both in terms of trade and their economic power and their growing military power and mindset, political mindset that they're trying to spread with Russia throughout the world. And that may seem so obvious, but I believe that is a real policy. And it reminds me of when I graduated from college. What I learned in political science and history in the mid 1980s, I haven't used for 40 years, essentially, Luis, because it was about containment. It was about hard power. It was about, realpolitik. And, we saw glimpses of that with President Reagan, but we really haven't seen a really hard power mindset from the United States ever since President Reagan. You could say the terrorism reaction and our Gulf wars were a hard power play, but that was related specifically to terrorism. We're talking about containment of another major power. And I think that's why I take these tariffs very seriously, because you hear the Trump administration talk about the idea of the tariffs being reciprocity. These are terms that would indicate hard power and that they are trying to roll back what China and Russia and other countries have done over the last 20 to 30 years in some cases. And so I don't think we're going anywhere with this policy. I think this is a real policy and it's going to continue and it's going to make the commodity markets extremely volatile, very good in some ways, maybe very bad in other ways. And we see that with the steel and aluminum tariff scare that we're starting this week out with. We see copper prices in New York now widening in terms of premium against other parts of the world where copper supplies are. So it's going to take a lot of effort and a lot of brain power to navigate this time period, I think.
Yeah, and that comes to the next topic that I mentioned before is that one viewer asked about the possible impact on Brazil. I understand the viewer is from the UK, and he asked, and one of the impacts is already happening on the announced steel tariffs that Brazil exports 48% of its steel to the United States. So that's a big impact on Brazil. Well, on the other hand, I don't think that the agricultural commodities will be directly impacted by any tariffs, as the United States only imports coffee from Brazil, and I don't think President Trump cares so much about agricultural goods like coffee or related commodities. How do you see it?
Yeah, I mean, I would kindly disagree or be very careful about that assumption because of the copper example. You know, we could see, I think, a situation develop where Brazilian and Argentine commodity prices nosedive in terms of price versus US prices. And when it comes to beef, when it comes to poultry, when it comes to soy meal, you know, there are infrequently those times when we bring in South American meal into the Wilmington Bulk, South Carolina port. I could see very easily the Trump administration not allowing that to happen, where we put up barriers for import on specific agriculture goods, so that we don't see a cheaper Latin American price due to our tariff policy allow for importation. And I think that's where it goes back to wheat. In Europe, we saw last year where we were bringing wheat into the eastern seaboard. I think that could also be on the table for trying to keep that from coming into our country. I would say to the person that asked that question, the first thing I'm going to be looking at in the short term, having said what I've said, is China is working on, by several media outlets and contacts that I've looked at, a proposal right now to try and stem the tide of an outright trade war with the United States. They have said that they are. This is what we're hearing, rumoring that they will not devalue the yuan, in order to increase their exports. That they will stop fentanyl and reduce fentanyl precursors from coming into the United States. And there's some people that think they're going to come in and try and pick up where the phase one trade relationship was back in 2017. And that actually maybe would mean increased agricultural imports from the United States. And I think this works really well because look at what the gold continues to do. The gold continues to make record highs. It's, I think, a safe haven because the market is worried about the US China relationship in terms of the global economy. But I think it's also an inflation safe haven because we're stuck in the United States with high inflation. And these tariffs are only going to make that inflation even higher. So I think the gold's an excellent example of what this market's trying to tell us right now. And I would pose the question in my analysis: how much weaker could we expect the U.S. dollar to get against the emerging markets? Like that's what's happened the last few weeks and helped elevate us in prices for grains and other commodities. How much more can we really expect the dollar to soften against these emerging markets at this point, not knowing what's going to happen between the United States and China? So I really think the US and China is the next big piece of the puzzle that would allow the commodity markets to keep rallying or would take away premium that we've recently put in.
And taking the reciprocity aspect of this, if the US is going to punch back all the products that Brazil taxes the US companies, then will be another huge impact because so many products have tariffs to enter Brazil at this point. And yet, because of this, today Lula has announced that Brazil would tax big tech in a retaliatory movement if the tariffs for Brazilian steel takes effect. So that's why he can't go anywhere else because Brazil already taxes American products.
Yeah, and I'm hearing that from China, and I'm hearing that from Europe as well. And you bring up another interesting point that maybe helps round out this containment strategy that I'm throwing out here. And I know it's a big piece of analysis, but when I heard the term external revenue service, and then I heard that President Trump's administration is going to try and use tariffs to help pay for a tax cut for the American people and the American middle class, it made me realize that this is a real situation that we're in right now, and that if we do see the external revenue service get created here in this country, again, I take that at face value with the idea that the tariffs are going to be more likely to be used as a trade and economic and foreign policy tool. Some would call it a weapon, but I will call it a tool in order to not only get the reciprocity side of the equation, but also to try and lower taxes for the American people. And I think that's probably how President Trump and his people are going to try and push this out and quote unquote sell it to the American people if they continue to see high inflationary prices. Yeah, you got higher inflationary prices, but we're going to give you a tax cut. I could easily see that type of motivation or that type of movement in the policy. Why? Because he wants to contain China's Belt and Road. I think what we talked about with the Monroe Doctrine and how China is so far into the Western Hemisphere now, I truly think President Trump's number one goal of his presidency is to rebalance the world back so that the United States has more leverage again, especially in relation to China and Russia. Why would that be? Because we see them as authoritarian countries as opposed to liberal democracies. And so anyone that is kind of angry about what the United States is doing right now, this is all part of what we are supposed to be representing, in my opinion, as far as to the world, a liberal democracy as opposed to authoritarian regimes. And that's, I think, how President Trump sees it.
So, considering all that context combined with erratic weather that we have been seeing in South America, we also can tell right now that the quality of soybeans has reduced in some areas of Brazil. So, what do you think is going to happen in terms of trade in the upcoming month?
Generally, in a big picture with the WASDE report, just about 24 hours away from us doing this video, I have brought down my Argentine corn crop to below 48 million metric tons. I brought down my Argentine soybean crop to about 50 million metric tons. I'm roughly 2 to 3 million metric tons less than USDA. What I want to see in the WASDE report is A, do they see what I see in Argentina? And B, do they increase the Brazilian crop to offset that? Or do they cut the Brazilian crop as well? Because at the end of the day of Tuesday, Luis, we're going to have to start thinking about the idea, is the weather market rally over in South America because they're harvesting and new crops, corn and bean supplies are going to be hitting the world market and are going to be hitting the Paranagua and the Argentine upriver prices. And I think that's what I've got to deal with the second half of February for my clients and subscribers. I mean, can we extend this weather market through more bullish, price friendly USDA data through the WASDE report, thanks to South America? Or does USDA say, no, we've got a 170, 171 Brazilian soybean crop? It can more than offset the losses in Argentina. And maybe the corn we do, take down the net production for South America, but soybeans then resume as the leader to the downside because those supplies are coming on and coming on fast.
And how our viewers can check your analysis to learn more about it. Do you still have the trial version?
Yes, absolutely. 2 week trial on globalcomresearch.com. I did have a quick question for you, Luis. I had heard a fellow in Argentina say that they were going to be losing 2 to 5 million metric tons of corn and beans a week if they did not get the rains that they were scheduled to get last week. I'm seeing only like half of Argentina getting the rains they needed. Where do you see Argentina right now from your contacts?
Yeah, so there was some erratic rainfall that would not cover all the needs of rain for Argentina. So I agree that there will be a substantial reduction.
Thank you.
All right, anything else would you like to add, Mike?
No, but thanks again for having me.
Thank you.